Same issues, same people, same countries. Do we get a different outcome?
In terms of trade, I don't think so. I think trade is sort of in a perpetual state of negotiations. I think we expect that to continue, and we're not expecting a major breakthrough anytime soon. In the financial markets, things seem to be changing a little bit. Yields moving up, and most importantly, the yield curve steepening is actually a material change. It seems like the Fed's rhetoric, the Fed's action is actually starting to sort of meaningfully impact the technicals in the market. And when we think about just sort of fixed income in general, one of the biggest challenges the Fed has faced is an inverted yield curve. The fact that they're actually getting the yield curve to steepen is a meaningful positive, and I think that is something that's very different than what we saw sort of, let's say, just back in the middle of this year when the trade talk and trade issues really became meaningfully problematic and really started to push down yields.
Michael Purves?
You know, it's days like today where I'm sometimes convinced that there's somebody in the basement of the White House who has got an algorithm that fuses Trump's approval ratings, the impeachment narrative with the VIX, credit spreads, and CEO confidence about the economy, and says, okay, now it's time to soften up. And then, but in all seriousness, I do wonder whether, you know, Trump is really effectively trying to sort of collar risk appetite here more broadly right now, right? You know, where this impeachment narrative goes, is it going to really drive him to get something more definitive and real with China? Because I completely agree that there's not really, this is just, come on, we've seen this movie before.
We saw this in February. There was talk of an FX pact. There was talk of buying more soft commodities. They hailed the deal, and then it all exploded several months later, which makes me wonder, Andy, if we don't tackle the big issues, have we really tackled anything at all?
No. This yo-yo doesn't help anybody. You want a concrete certainty for corporate America, for them to be able to feel confident in investing for the future. And that's the noise that we get day to day in the market is somewhat irrelevant. It's the corporate investment that needs to come back, and for that, I think they need certainty.
Well, looking at the market right now, I wonder what is noise and what is signal. My colleague Luke Cower and Tracy Alloway as well, pointing out that we've really had two halves to this week, George. The first half incredibly negative, but we didn't get a big move lower in Treasury yields.
Right.
The second half positive and a big push higher in Treasury yields. What does that tell you about how tough life is down here for a 10-year in and around 150?
Yeah, I mean, the signaling from our perspective is that it's very politically driven, and so you've kind of got tail risk, whether it's trade or maybe we'll talk a little bit about Brexit later on, but some very...
I hope not, but carry on, please.
But these very big sort of overhangs that have been weighing on the market, you know, are dissipating just a bit, and whether or not they get better, maybe it's sort of an indication that they're not going to get any worse, and maybe there's sort of a cap on how far we've gone with respect to sort of trade tension. And so this may be an extended period of negotiation. That seems to have overshadowed the data. The data came in pretty weak last week and this week, and that got people very anxious. But then the Fed is now kind of riding to the rescue. Liquidity solves all problems in today's markets, and so this extra dose of liquidity, this sort of term repo agreements, and sort of the new non-QE QE is certainly helping risk appetite. And I think about it in very selfish fixed income terms. You know, there is sort of a liquidity squeeze that's been building up for a variety of reasons, and the Fed is stepping in to basically unclog that squeeze. That in and of itself is a positive.
There has been some debate as to whether it's QE or not QE. For me, what matters, what are they doing, what's the objective, what are they buying, and what are the consequences? We found out today that they're going to be buying up to $60 billion of T-bills, pretty much every month going into 2020. It might be higher, it might be lower. What does that mean for you? Because what we have seen with the Treasury curve, 3-month bill versus the 10-year, finally a little bit of steepness, a positive spread. Do you expect that to continue?
I do expect that. We do expect the curve to continue to steepen, and I think what it signals, and as I mentioned before, you know, there's a sort of a liquidity squeeze buildup kind of that's been mounting over the last several weeks as we headed into the end of the quarter. You saw it in the repo market. You're sort of hearing about it in different parts of the fixed income world. I think that's a function of kind of a flat to inverted yield curve, kind of the structure of excess reserves. There's a variety of things. But the Fed is focused on breaking that logjam. And in doing so, that releases a lot of tension in the market. And I think that's a positive going into year end.
Michael Purves?
I think just another facet of of this whole discussion about the torque that's been sort of built up in this markets. This squeeze potential also gets back to the Eurozone and China to some degree. If you measure the spread between the EM equity ETF, that volatility metric relative to the VIX, that's at year-to-date lows right now, right? And you look at some of the economic data coming out of the Eurozone, it's certainly not getting sustainably obviously better, but it's seeming to bottom. So, play a scenario out here where these Bund yields are going to, if they do march back to zero, that's going to re-steepen our curves over here pretty sharply.
Andy?
Yeah, I think you need to bear in mind that the Fed's operation at the front end, you could almost see it as a reverse operation twist. They were getting sick and tired of this self-fulfilling prophecy of an inverted yield curve. How many times has it been discussed on this show? By buying all those short-end paper, by providing liquidity that George referred to, suddenly the curve steepens. Those models that tell everyone recession's round the corner, no one's talking about it anymore. So you've got to be careful. There's some smart strategy going on.
That's helping the 3-month to 10-year. Let's talk about the rest of the yield curve. This is shaping perceptions over what the Fed will and won't do at the end of this month. If these trade talks go well, and for anyone watching this over the weekend, we are recording this ahead of the conclusion of these trade talks. So if these guys get it wrong, you can throw mud at them on Monday. But we don't know the outcome just yet. But George, looking at that situation right now, it's interesting to me that when I speak to economists and ask them the following question, if it's a truce, but the tariffs don't come off, what does it mean for the economy? They turn around to me and say not a whole lot. But the market participants admit that we'll get a short-term squeeze in the market, which makes me wonder, if the market is reassessing the chances that the Fed moves at the end of the month based on what happens with this trade talks, aren't we basically also making the judgment that this Fed is managing the markets and not the economy?
I think they've had to walk a pretty tight line in the sense that they have, up until very recently, not really talked a lot about the technicalities of what an inverted yield curve does to their funding and their operations. And there are some economic consequences, but there are a lot of financial front-end consequences, and they've finally started to dial in on that. Their view that this is sort of a mid-cycle adjustment would suggest that that's really more their economic view, that they're not intending for this to be a sustained rate-cutting cycle. Now they've left the window open if the data continues to deteriorate. But if they are able to sort of cut rate one more time, steepen the curve, and allow sort of the markets to adjust, they could be on hold for a little while after the end of this month. That's our central view, that they don't do anything till at maybe the next quarter, that they're on hold till through the end of the year, as the rate structure sort of stabilizes and then these liquidity provisions start to kick in.
Marco Purves?
I think there's another dimension to the Fed's calculus, which they can't really talk about, but I guess I can, which is that as we're looking into the election year, if they do start cutting aggressively, and then let's say, a lot of the economic data, the trade war comes to a defined resolution sometime early next year, things are better overseas, and inflation is starting to stoke back up, then they're faced with having to raise, perhaps, into November 2020, which is typically the Fed isn't fond of doing, right? And you can only imagine the amount of tweets that will be coming out of the year from now.
I know someone else that might be fond of that idea as well, Michael. What's your take, Andy?
I think the market's going to bully them. They have to move in October. I don't think anything substantial is going to come out of the trade talks that's going to change that direction. We've talked about it before, the way that the Fed has a third leg of their mandate, which is to continue the expansion, which is measured by what we see on our Bloomberg screens every morning. And I think that piece means that they definitely do the 25 and then maybe on hold, because they still want to keep some dry powder in the event that it's much worse than any of us think.